Everyone, welcome to my channel. I'm Doris. I'm here to show you about my stock account update. Today my stock account has made a loss of $399 US. US stocks closed down. The Dow Jones fell 360 points. The market focused on banking crisis and the Fed meeting. So let's first take a look at my account. Today my account has earned $300 including the post-market price. United Natural Gas made a loss of 3.99% in the market and 0.32% in the post-market. Right now it has made a loss of $1,163. SPXU today rose for 3.23% to 13.43, and I've sold all of it as a result of the gain. And SQQQ made a gain of 2.62% to $29.81. Right now, the net asset of my account is $71,277.79. So let's first take a look at the industry map. Today, Nasdaq Composite closed down with 1.08%, and the S&P 500 closed down 1.16% to 4,119.58, and the Dow Jones Industrial Average closed down 1.08%. Today, the industries generally closed lower, with the financial industry and the oil and gas. The energy industries closed significantly lower, and the financial industries, including the regional banks and the credit services, closed down more than 2%, and the energy services closed down more than 4%. And the tech industries influenced by these industries are also closing down more than 1%. U.S. stocks closed lower on Tuesday. Concerns about the banking crisis returned, and the bank shares fell overall. The Federal Reserve began its two-day monetary policy meeting today and announced its results on Wednesday. The agency is widely expected to raise rates by 25 basis points. The Bank of Philadelphia index KBW fell as much as 5.4%, hitting its lowest level since November 2020. Regional bank shares fell as some in the industry still worries as more could be. Alex West fell more than 27% in the morning, triggering circuit breakers several times. Pacific fell more than 40% in the early trading, triggering circuit breakers. The New York Stock Exchange will start delisting procedures at the First Republic Bank. Investors were focused on the banking sector after the weekend. JP Morgan won the troubled First Republic. As a part of the deal, JP Morgan acquires all the deposits and the vast majority of the assets of the banks in the region. After the First Republic Bank was acquired by JP Morgan, some American financial experts pointed out that the acquisition was only a stopgap measure, and that in the long run the problems in the U.S. banking system still exist. BMO capital market analyst James Featherton said, "This is another one-off solution. This liquidity crisis, we are concerned that the market will find another target with financial problems. Congressional action will stabilize the system-wide liquidity, but despite another bank failing, Congress still seems reluctant to act." The Federal Reserve began its two-day monetary policy meeting on Tuesday and announced its results on Wednesday. The takeover of the First Republic Bank by JP Morgan Chase has once again raised expectations of a pause, raising the chances of May becoming the last months of the Fed to raise interest rates. The Fed is now widely expected to announce another 25 basis point rate hike. According to CME's Fed Watch tool, there is a 97% chance that the traders will raise interest rates. Financial correspondent Nick Timmermans, known as the new mouthpiece, said the Monday that he expects the Fed to decide raise rates by 25 basis points at the meeting, pushing the Fed funds rates to a 16-year high, from 5% to 5.25%. Investors will look for clues on the Fed's future policy stance on whether it'll keep interest rates stable after the meeting, or whether it'll tighten monetary policy further to fight against inflation. Economists focus on the rate decisions themselves, but also on the guidance of the federal officials on their future policies. Fed Davis Research Chief Global Macro Strategist Joe Kalish said, "We believe this will be the last rate hike in this tightening cycle. However, We believe, however, the Federal wants to retain its policy flexibility in case what happens to the economic data released ahead of the next Federal Open Market Committee meeting on June 13th to 14th. As a series of bank failures injected a new uncertainty into its fight against persistent inflation, several Fed officials stressed the need for flexibility and selectivity at their last policy meeting in March. This will remain priority for FOMC members at this week's policy meeting and could mean the end of the historic monetary tightening campaign. As recent as March, most federal officials called 5.25% is the highest rate for the year. This week, officials will revisit whether to suspend further rate increases. Goldman Sachs chief economist Han Jesus said Fed officials would avoid a strong signal of a pause in the rate hikes for fear it could reinforce expectations for the Fed's abrupt reversal of policy course and cut interest rates sharply this year. Future markets show that most traders are betting that the Fed will cut interest rates below 4.5% later this year through early 2024. Officials disagree. The Fed wants to avoid getting the market to conclude that a rate cut is coming, so I think policy signals will suggest that risk favors further rate increases. Jesus said he doesn't expect the Fed to cut rates until 2024 because he believes inflation will fall slowly from now and the economy will not fall sharply. The Treasury said it could reach the debt ceiling earlier than expected. Treasury Secretary Janet Yellen warned that the U.S. could make debt payments as early as June 1st, ahead of Goldman Sachs' estimated July deadline. On Tuesday's economic data, the U.S. March job vacancies and the labor flow report showed U.S. March job openings at $9.59 million, compared with $9.775 million expected, and $9.931 million last. Gross was the number of jobs. Vacancies fell for the third straight month in March to a nearly two-year low. The data shows that the demand for U.S. labor is gradually slowing, which will eventually make the job market more balanced and ease the pressure on rising wages. While some companies, especially in the tech and financial sectors, have laid off workers, the overall labor market has remained resilient and has been the backbone of America's fight against recession. The turnover rate, a measure of voluntary turnover in the total employment, fell slightly to 2.5%, unchanged from the lowest level in 2 years, according to a jobs report. That's amount to the departure of about 3.9 million Americans, reflecting a decline in the workers in the accommodation and food service industries. U.S. durable goods orders for March revised 3.2% month-to-month versus 3.2% expected versus 3.2% last. Factory orders, excluding transportation, were negative 0.7% month-to-month in March, compared with negative 3% last. U.S. factory orders were 1% rise in March versus negative 0.5% last. U.S. March factory orders was 0.9% month-to-month versus 1.1% expected versus negative 0.7% last. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.